putting posts out there, you know, looking to raise money for their deals, and they're posting interest rate returns or silly words like guaranteed.
Ooh,
Yeah, big no-no. But
big no-no.
yeah, talk about that a little bit.
Yeah, so my clients don't like me. They say, "What can I post on social media?" And I say, "Well, if I could give you my real answer, it'd be nothing." And that's not the true answer. With social media, you've got to be careful. I always tell them, don't get into specifics. So, say, "Hey, here's the types of projects we do. If you're interested in finding alternative investments, reach out to me and let's talk."
Welcome to the Generations of Wealth podcast. I am your host, Derek Dombeck. Today, this show is a little different than what we usually bring because we have an SEC attorney who all he does primarily is structure syndications and the paperwork for syndications, and he's done a lot. You'll hear it in the show. Before that, I try to always bring value to you guys, and part of that is, reach out to me, reach out to us here at Generations of Wealth. If there's anything we can do to help you, certainly go to thegenerationsofwealth.com, derekdombeck.com, or shoot me an email, derek@globalgow.com. And whether that's help with a deal, just a quick question, or need me to connect you with somebody that I have a relationship with, happy to do it. So with that, let's bring on our guest. And as promised, superstar attorney Nic McGrue. Nic, thanks so much for joining us on the Generations of Wealth podcast.
Definitely. Thank you so much for having me. Looking forward to having a great conversation here.
Absolutely, absolutely. Let's just start it off the way I always start off. Tell the world a little bit about yourself.
Yeah, so my name is Nic McGrue. I'm the founder of Polymath Legal. At Polymath Legal, we help real estate investors lawfully raise capital so they can generate passive income while creating generational wealth. So we work in the securities world. So if you're raising capital, we help you navigate that very complex and sometimes scary industry to make sure that you're raising the capital properly so you can focus on your project and we handle the legal stuff.
So are you trying to say that people raise capital and don't do it legally?
Oh, I would never say that, but I'm sure we've all seen plenty. So, while I didn't say that, it absolutely happens more regularly probably than it should, but yeah.
Yeah, and I think that's some of the things that we're going to touch on today, just to, the common stuff that we see people doing, especially newer investors that think, oh, it's fine, nobody's going to catch me, or they just don't even know any better. But before we really get into any of that, what's kind of your background? What led you to where you are today?
Yeah, so in law school, kind of early on, I liked the law. I like how it makes you think differently. It's very ordered and rule based, which that's how my mind operates. So I liked what I was learning in law school, but law school focuses on primarily on litigation, so fighting in court. And after my first year, I was like, I like what I'm learning, but I don't see myself fighting in court all the time. That's just not who I am. I don't really want to do that. And so I took a class called, in my second year, took a class called Entrepreneurship in the Law. And it basically taught us, working as a lawyer, advising and guiding entrepreneurs. And through that program within my law school, they also had a lot of business and real estate law classes. And so once I took that class, I was like, yeah, this is the route I want to go. And so with that, I took a lot of real estate classes as well. Real estate's always been something I've been interested in. And so when I started the firm, and we still are doing business and real estate. And we were primarily just doing the transactional side. I actually did a few. My first syndication actually was a winery, not even a real estate one. A client is a family-owned winery, and they hadn't ran the winery that well, and so they had one of the grandsons or whatever had gotten his MBA and was coming in to kind of right the ship. And so we need to raise some capital. So we sold off a small portion of the winery through a syndication. And then my second one actually was being in LA. It was somebody said, "Hey, I've got a movie script. I need 600 grand to make this movie. I need to raise capital." And so we did a syndication for a movie script. And it wasn't until about 2 years later, I had a real estate client and she had probably 30 single family homes, and she's just like, man, this management is ridiculous. I'm so busy all the time. And I said, listen, why don't you consolidate, liquidate all of those and just buy one building. And she came back and she said, I think I want to go bigger. Have you heard of a thing called syndication? And I was like, yeah, of course. And so she's like, yeah, I think I want to do more than just 30 units. I want to, get some friends and family and other people involved. And so that was my first real estate syndication with that client. And she liked that. And she did, I think, two more that year. And I also liked it because at the time I had done just, a handful of syndications. And I was like, this is great. It combines the real estate and the business, and it's kind of a very niche area. And so this was around 2014 or 2015 when I started doing the real estate ones. And I'd say probably since about 2017, it's like 70% of what we do. So we're doing funds or syndications day in and day out.
Well, and to give the audience a little bit of an idea, I was kind of looking through your background and your bio, and you've been involved and helped clients raise and acquire uh, more than $2.5 billion in assets. So billion with a B. So you got a couple nuggets here, I'm assuming.
We've learned a few things along the way for sure.
Yeah, that's awesome. That's awesome. So I guess what kind of got you fired up or inspired to focus on helping real estate investors raise capital the right way?
Yeah, part of it just seeing so many people do it incorrectly, and the consequences are, I will say this, the consequences are relatively rare. For the amount of people that I see it doing incorrectly versus the amount of people that get in trouble, it's drastic differences. But what I will say is that for the ones that do get in trouble, the punishment is not fun. And so particularly with my clients, I'm like, I don't want them to ever have to deal with those kind of situations. And I remember even early on in my career, and when I was kind of just starting to make a name for myself in the syndication world, I had been taking a lot of meetings with people that are saying, "Yeah, we want to raise capital. We're looking for a deal." And so I talk with them, do an intro meeting, and kind of got to know them a little bit. And they're like, "Great! If we once we find a deal, we'll start working with you." Well, apparently there was some deal that a lot of people had been capital raisers for, and there was one week where I got like five calls of these people who were not clients yet. I talked with them, but I hadn't done anything with them. And they're like, the SEC sent me a litigation hold letter. They're telling me I can't delete anything, and they were all panicked. And thankfully, I knew what it was. I was like, well, this doesn't necessarily mean that it's something that you've done wrong. It just means they think you have information that they might want. But I remember with getting all of those calls, I thought to myself, whew, I'm glad I wasn't the one that set those things up. But even more so, I said, I never want to be in a situation where I'm getting these calls from a client and I'm scared, or I'm like, oh my goodness, how do we fix this, or what can we do? And so I wanted to make sure that with my clients that we're doing everything properly, crossing the T's, dotting the I's, so that if we get those calls, and we've gotten those calls, and I'm just like, okay, here's what we're gonna do. We're gonna show them this, we're gonna show them that, and we're good to go. And so yeah, when I remember that week very clearly, thinking, man, I would be so scared if these were my actual clients. And I wanted to make sure for sure that I never had moments like that with my actual clients.
Yeah, definitely. What do you feel like are some of the most common wrong ways that people are out there raising money?
The one that I see the most, and it's not always wrong, but it's often wrong, is joint venture. They say, oh, we'll just do a JV. A joint venture is essentially a partnership for a specific duration or a specific project. But the big thing with a joint venture is that all of the joint venturers are having some active participation in the deal. And so I've seen people that say, "Oh yeah, one of my JV partners," and then they talk about what they do, and they're like, "Oh yeah, they wrote a check." And sometimes I'll ask them tips or advice, and I'm like, that doesn't sound like they're being active." And so again, if you are passive, most of the time that means that you're selling, or if you're having passive investors, most of the time that means you're selling a security, which means you need to either register or have an exemption, and a JV is not a securities exemption.
So if you just bring on, is there a number, right? So if you bring on one investor and they're going to fund part of your deal or all of your deal, and it's done through either a joint venture agreement or like a participating note or a promissory note secured by a mortgage, is that considered a security or is that considered a loan? How does that? And I know these are vague questions, really just trying to narrow this down a little bit.
Yeah, so obviously we'd have to look at the exact situation, but what you said, likely those are securities. However, for instance, if we're dealing with generally if you're doing a short-term promissory note, so 9 months or less, the SEC just says we'll count that as an exemption. Don't register the shortness of it is an exemption of itself. Or also in certain circumstances, if it's a single family home and you have a mortgage on that. So like if you have a lending partner and they put a lien on that property, a lot of times that will be an exemption itself. So it's not always that when you're selling a security, you've got to have the giant PPM and Form D and all that sort of stuff. That's often how it's going to be. And particularly if you have multiple people or multiples of people, then that's likely what you'll need. But and like we said at the beginning, it's very nuanced. And
Mhm.
so yeah, the situations that you talk about, those likely are securities, but from what you said, also there likely are exemptions within that as well.
Yeah. The one that I see the most and the one that people they don't even ask me about, I call people out on it when I see them doing it on social media is putting posts out there, you know, looking to raise money for their deals and they're posting interest rate returns or stu silly words like guaranteed.
Ooh,
Yeah, big no-no. But
big no-no.
yeah, talk about that a little bit.
Yeah, so my clients don't like me. They say, "What can I post on social media?" And I say, "Well, if I could give you my real answer, it'd be nothing." And that's not the true answer. With social media, you've got to be careful. I always tell them, don't get into specifics. So, say, hey, here's the types of projects we do. If you're interested in finding alternative investments, reach out to me and let's talk. Most people are not going to invest in your deal from a post if they don't know you beforehand anyway. But by putting in those details, you're setting yourself up for potential issues. And my biggest thing with social media is I tell my clients, I'm like, listen, for you to get more specific on social media, the disclosure that I want you to put on there would take up, especially if we're talking about an ad, it'd be the whole ad. Or if you're gonna say it orally, that's gonna be your first 30 seconds. It's gonna be some long, boring legalese. And so I tell clients, I say, keep it simple, talk very generally, and your goal is not to get them to invest with you. Your goal is to have them reach out to you so you can have a fuller one-on-one conversation. And with that, you can give them the full picture. Because when we're looking at social media, even if it's a video, usually it's like 90 seconds, and there's no way you can give a very clear picture in 90 seconds of a full project of what you're planning to do and the risks and all that sort of stuff. And so I say the goal is to get them just interested enough to reach out to you so that you can then have a conversation and start building that relationship because that's ultimately what's going to make them invest with you most likely.
Definitely. Definitely. So why don't we describe a few different types of syndications, right? Like there's debt funds, there's equity funds, there maybe go into a few of those.
Yeah, so I'd say at least on my end, anecdotally, the most common is equity-based deal. So if we're doing, actually, let's even go back and talk about syndication versus fund. So with a syndication, generally that means you're raising capital for an identified asset, or maybe even multiple assets, but we know where my money's going. So if I'm an investor, I can go underwrite that apartment building myself. I might know the neighborhood and things like that, so I can vet that specific asset that I'm investing into myself. Whereas with a fund, you're saying, hey, I know how to find assets and I haven't identified them, or at least I haven't identified all of them, but invest in me and I'll find good assets. And so a fund, obviously, there's a good amount more risk there, at least theoretically, because as an investor, you're really betting on the operator themselves. Whereas with a syndication, you're always betting on the operator because a bad operator can make a good asset go bad, and a good operator can make a medium asset become good potentially. So you're always betting on the operator to a degree, but with a fund, you're fully betting on them because you don't know what they're buying. You might know generally where they plan to buy, but and the general types of things they're going to buy, but you don't specifically know what it is. And so with a syndication, they could say, "Oh, we're buying that apartment building," and you might know that neighborhood and say, "Oh no, that neighborhood's going down. I don't want to invest." With a fund, the fund manager could be buying that exact same apartment building, and you won't know. And so even though you know that you wouldn't have invested in that because you've given that authority and that trust and delegated that power to the fund manager, then you're going to be invested in it regardless. So that's the main difference between syndication and fund. Syndication, we know where our money's going generally, whereas a fund, you're betting primarily on the operator to find good assets to deploy that capital.
Okay. So
Um,
equity versus debt.
Yeah, so this looks at more now your relationship with your investors. With equity, your investors are your partners. If the deal does great, they're going to do better. If the deal doesn't do great, they're not going to do great. And they theoretically could even lose all their capital and have zero recourse for it. Whereas with debt, your investors are essentially a creditor of yours. So you're essentially taking a loan from your investors, and usually you're going to have a promissory note, and you're going to tell them that you're going to pay them a certain percentage. And if you don't service that debt, they will have means at least to go after the entities. We typically set it up to where the management team and the deal itself is all limited liability entities. So there's usually not going to be a whole lot of personal liability on the operators, but nonetheless, they could go after whatever assets the syndication or fund might have to satisfy the debt. Because a debt, you owe them that money. Whereas with equity, we're hoping it does well. If it does well, I'm going to share some of the goodness with you.
Mhm. One of my pet peeves, and I've interviewed quite a few syndicators on this show, is raising money as a second position syndication behind a bank. And right now, as we're recording this, we're at the tail end of 2025. There's plenty of syndications, and especially in the apartment complex space, they're going down.
Mhm.
Cap rates have changed, interest rates have changed, debt is coming due to the first position lenders. What's your experience, and then what's your opinion on these types of syndications when they're raising money in second position?
I don't know that I've had uh, I've had clients do it in the sense kind of as a distress a distress mechanism. I haven't had them do it as an actual that's the original business plan. Kind of as you're talking about the market right now, I unfortunately do have a lot of clients that are doing capital calls because, as you said, their cap rates are expiring. And with how the interest rates are and things like that, just the refinancing doesn't make sense. So with that, I have had some situations where clients are not able to meet their capital call. And so instead, they will do kind of raise a second layer of capital. A lot of times they'll do it in a structure that's similar to like preferred equity or mezzanine financing. Because a lot of times, what clients used to be able to do 2 or 3 years ago, they just go get that bridge financing or mezz financing or whatever. But now that's a little bit hard to do. And so sometimes what they're doing is they will create a structure to where they're raising from either their current investors or maybe future or new investors, but they're creating a new part of the capital stack that's kind of above the current investors because they're saying, listen, current investors, we need this money or we lose the whole thing. And so I'd rather put you in lower priority to where you still have a chance to get something back versus we don't get the money and you lose 100%. So it is very risky for sure. Absolutely risky. Um, a lot of times, though, because it is risky, the terms are going to be a lot better as well. And so I'd say especially if you're thinking of investing in something like that, you want to really understand what the operator's plan is, because clearly they're, at least in my scenarios, they're in distress, and so they're doing this as a way to get out of that. And so you want to understand what happens if they can't raise all of it, or what are their backup plans, or how long is this capital going to last? Are we going to be in the same position 12 months from now or 24 months from now? So you definitely want to understand what, especially if it's a distressed asset, you want to fully understand what is the plan to right the ship.
Yeah, for sure. For sure. Well, I guess let's go back to structuring. So what legal documents and just I guess step by step is basically non-negotiable? What has to be in place for a syndication?
You're going to need some sort of governing document. We like to structure as LLCs. There are occasions where a true limited partnership structure is what we use, but usually we use LLCs. So you're going to have an operating agreement or company agreement, depending on which state you're in. The other big document that a lot of people are scared of is the PPM or private placement memorandum. That document, especially as an investor, that is what you really want to look at. And the SEC requires this to protect investors. But I also tell my clients that are the operators, I say this actually protects you as well, because there have been numerous times where An investor says, "Oh, I didn't know this," or "You didn't tell me this," and we go back to the documents and we point right to where they initialed next to them saying, "I agreed and I read this." So it saves the operator in the sense that you are fully disclosing everything and thinking about all the bad things, letting the investors know about those bad things, and letting them decide if they want to move forward. A lot of times, especially newer clients that I have, there's parts of my PPMs that will sometimes be in bold or all caps that says, "You may lose all of your money." And they're like, "Can we put this, can we like make this smaller? Can we unbold it?" And I say, "Listen, when you tell me things like that, you just make me want to highlight it more because those things that you're, especially as a new person, the things you're afraid that, ooh, this is going to scare the investor away, we want them scared away if it's going to scare them
Mhm.
away because these are things that could happen. And so we'd rather we say up front, hey, this might happen. And they're like, oh, I don't want to deal with that. I'm not going to invest. And then we say, great, we'll let you know about the next deal. Versus we kind of brush that under the rug and then that thing happens. And now that investor is like, if you had told me this, I would have never invested. And so we want those scary disclosures in there because that's part of what the PPM's job is. It is there to push away the investors that don't like the risks that you're telling them. And so that's one thing that especially a lot of new people don't fully grasp or understand. It is going to look kind of scary. It's going to sound like the world's ending. You're going to, name your third child after me. You might lose all the things you ever worked for, but if this sounds good for you, go ahead and invest. That's essentially what it's written. But it's also going to talk about your business plan. It's going to talk about who the operators are. And again, it is going to disclose those risky things. One of the things that I even ask clients as we're drafting them, we have them go through a long questionnaire. And one of the last questions is, what keeps you up at night? What are the things that you're afraid of? And I ask that so that I can use that to make some more risk factors because even the greatest deal, there's going to be some things that you're like, I hope this works out, or this could be could throw things off if it doesn't work out so well. And so we want to know those so that the investors can also understand that information because in a public offering, they get all that stuff. I can go right now and see what the CEO of a public company makes and what their budget was and all that sort of stuff. With these private deals, there's not that level of disclosure. So the PPM is essentially that disclosure. So PPM is the big thing. And then for real estate, most of my clients use one of the Regulation D exemptions, so 506B or 506C. And so with that, there's two things that we have to file with the SEC as well. So yeah, your operating agreement, your PPM, and your SEC filings are the absolute must. There's a few smaller things that you also must do, but yeah, those are going to be in pretty much every deal. You're going to need some form of those things.
You might as well just explain real quick the difference in the Reg D filings because that determines who you can raise from, and then we'll kind of segue into accreditation.
Yeah, so when I'm talking with clients, a lot of times I'll ask, how much do you need to raise? How quickly do you need it? And who are your investors? And that helps inform us as to which exemptions might work. And so with Regulation D, there's two subparts, 506B and 506C. For 506C, you've got to be 100% accredited investors. And so there's lots of ways to be accredited, but for everyday people, the two main ways is income or net worth. And so on income, if we're talking about an individual, you've made $200,000 or more the past 2 years, and you expect to make that much or more this year. If we're talking about spouses, then we up that number to $300,000. So you make 200,000 as an individual or 300,000 as spouses, then you're likely accredited. Or if we're looking at net worth, then we say, is your net worth $1 million or more, excluding your primary residence? So we take out the value and equity you have in your primary residence. Outside of that, do you have $1 million in net worth? If so, you're accredited. So 506C, all of your investors must be accredited. However, you can advertise, you can do general solicitation, and you can have people invest that you just met, or maybe you had that very generic Facebook ad. They reached out to you to have a conversation and they're accredited, and now they can invest in that deal. We contrast that with 506B. 506B allows you to raise an unlimited number of amount of capital, just like 506C. You can have an unlimited number of investors, just like 506C. However, we care about a lot more about who your investors are. And mainly what we mean is that you must have a pre-existing substantial relationship with all of your investors. So pre-existing means that you knew them before the deal was on the table. And the substantial part, the SEC has not clearly defined that to us, but I essentially say you need to know whether they're sophisticated or accredited and the reasons why. So you understand their investment background, maybe their net worth or their income or things like that. So with 506B, as long as you have a pre-existing relationship, you can have an unlimited number of accredited investors. In addition to that, you can have up to 35 sophisticated unaccredited investors. So sophisticated, again, not super well defined, but essentially they're financially savvy. They can look at your pro forma and your pitch deck and your PPM and see, does this deal make sense for my risk and my financial goals or not? And sometimes, if somebody themselves is not sophisticated, then with the use of a financial planner, they can use that person. If they have their own financial planner or financial advisor that's advising them, that can also make them sophisticated as well. We basically want to make sure that it's somebody who know and can figure out what it is that they're investing into and understanding the risks involved and whatnot.
Yeah, definitely. And I mean, I've raised a lot of money over the last couple decades, and honestly, dealing with people that aren't sophisticated and they're investing their life savings, and if it did go belly up, they would be harmed significantly. Those are the biggest pain in the asses to maintain relationships with anyways, because they
Mhm.
are so concerned about their 50, 100, $200,000. I mean, and everybody should be concerned. It's money, but you spend more time hand-holding and babysitting those people than you do with people that already understand the risk versus reward.
Absolutely. Clients often ask, is there a minimum amount that we can accept? And I say, no, you can accept as little as you want. But I tell them two things. Number one, I say, there's a cost to each dollar that you take in. Theoretically, my costs can be divided amongst all the dollars you raise and your accountant's costs. So there is some cost, and also just answering the phone calls and inquiries of those investors. So there's some costs to those dollars that you take in. So you want to take that into account. And then, yeah, I tell them the next thing. I say, the number one, you don't want to take somebody's last dollar. You just don't want to do that. And then number two, the higher dollar investors are just going to be much less of a headache, and also just overall numbers wise less. If you get one check for $1 million versus 10 checks for $100,000, you're going to have one person calling you versus 10 people calling you.
Mhm.
And then, like you said, that person with the $1 million investment, I literally have had clients say this. They're like, the person that invests $50,000 or $25,000, they're calling all the time, trying to figure out what's going on, seeing what's happening. The person with $1 million investment, I'm calling them because I'm trying to make a distribution and I don't know where to send it and I can't get a hold of them because they're just like, yeah, let it cook, let it do its thing.
Yeah, yeah,
Yeah, definitely
yeah,
agree with you on that.
definitely have lived that for sure. Oh, so what does it cost? And I'll just give an example because I know the cost can vary, but let's say somebody's putting together an apartment syndication. And what can somebody expect to spend to put it all together? And then the second part to that is what's a typical time frame to put it together?
Yeah, so obviously there's lots of variables, but for our pricing, if you're doing a syndication, you're going to range from about 10,000 to 18,000 right now. We are going to be upping at the top of the year, so it might go up a little bit, but yeah, that's what we do right now. Time wise, this year we've been at about for a very motivated client that has done it before. We've been able to push them out in about 3 weeks. We used to say about 4 to 6 weeks, and that's still what we generally tell clients. But we've been getting a lot of them done like in 4 months or not months, 4 weeks or less. 4 months, that's entirely too long.
Well, and that's also assuming that the client is getting you what you need when you ask for it in a timely manner.
That's exactly what it is. That's why I tell clients. I say, listen, we can do it as quickly as 3 weeks. There's always going to be delay. Like if we need something and you get it us to the day we ask, then yeah, we're probably going to wrap it up in 3 weeks. But usually we're going to ask you, it's going to take you a day or two, and that pushes that timeline back, and we're going to be asking you a couple of things. So that's why, yeah, we say probably 4 to 6 weeks is usually what you're looking at.
And then, so after you structure it and they've got this syndication in place or a fund in place, what does it take to maintain a fund? What does it cost to maintain a fund? The bookkeeping aspects of it, which might not be your forte, but I'm assuming you have some experience with accountants or something like that.
Yeah, so from the legal side, Your legal maintenance annually generally is going to be under $1,000, and oftentimes like quite a bit under $1,000. Typically, you're going to have your entity renewal fees, depending on your state, around $100. If you're still raising capital after 12 months, you may need to refile Form D and the state filings, so that can vary. And then if you have a registered agent, you might need to renew that. But that's going to be the primary legal maintenance that you're going to have. On the accounting side, part of it depends on the amount of investors and whatnot. But I'd say, at least from what I've seen, plan on about $500 a month or so. That should get you to the average. That should get you about where you need to be annually.
Okay. No, that's great information because not a lot of people talk about it. It's setting it up, but that doesn't mean it's done. You got to
Yes,
maintain it. You got to
there's one. The
maintain.
setting up is the start of it, and then you actually got to buy, execute, and then maintain it during that process as well.
So being that this is federal, so you're licensed in California and Washington, can you set up syndications nationwide or only in the state that you're licensed to practice law, or how does that work?
Yeah, so this is federal law, so it's the same across the board. So yeah, we have clients in many states, and most of my clients actually are not, especially in California, are not doing stuff in California. The land here is just so expensive that
Mhm.
you could take the same raise and almost buy a whole property for what you do to get the equity or your equity contribution here. So yeah, a lot of my clients, even if they're in California, they're usually buying in other states.
Makes sense. Makes sense. I quite honestly, I don't spend a lot of time in California. I talk to a fair number of investors from there, and I don't understand. This is just me. I live in the Midwest, but I don't understand um, the pricing model and actually even anyway taking the risk of trying to invest in California. I don't get
Yeah,
it.
I tell people California is where you come when you have money and you're just looking to preserve it because our property values generally are going to go up and it's a pretty stable market. But yeah, if you're trying to grow, your entry price is so high that you could go to other markets and just do so much better. Yeah.
For sure. Where do you see the future of syndications going and crowdfunding and just, raising capital in general?
I think that we're in a slower part of the market. I think we're going to see an uptick. Not that I am either for a couple reasons. Either interest rates have been lowering, and so that's been a lot of the issue the last year or two that's making things difficult. And then not that I'm looking for bad things to happen, but I think we're going to start seeing, or actually we're starting to see a lot of people losing properties. And so those properties are going to be coming back on the market and the people that have lost them, the bank that now owns them got them, at a fire sale or basically for nothing. So I think the numbers when you're buying a foreclosed or distressed asset might work out a little bit better than what our current numbers are and what, people that are holding were hoping on. So I'm thinking and hopeful that it's going to pick up. Again, not hoping for any bad, but just that's what how the market is. There's going to be unfortunately some people that don't do so well right now.
Well, the reality of that is, Nick, we need market cycles. That's
Hmm.
capitalism, right?
Yeah.
And I've been through them and I've been on the wrong end of them years ago. And you learn from experience, you learn from other people's experience and building a network, getting involved with the right people that have the knowledge that you need. But and I say this on this show, so my regular listeners, this won't shock them. We need a thinning of the herd occasionally,
Yeah.
right? Otherwise, all we see is inflation, 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 and everybody gets priced out. So,
Yeah, yeah, and I arguably would say it has almost was almost too easy for probably like 2018 to 2023 or so.
mhm.
There was one person, and there might have been there was a few that I just coached a whole lot to make them, but there's one person where I essentially just said I can't help you just because I kind of saw what was going on, and I was just like, I can't in good faith set them up to raise capital from people because I don't think this is going to work. It just they didn't have the knowledge, the experience, etc., to make a deal work. But during that time period, a lot of people similar to that person were getting into deals, and the market thankfully saved them. So yeah, I think the thing of the herd, so we can get the actual operators operating versus the people that are again, they did well and got lucky, but in a not as advantageous market, are going to struggle quite a bit. So yeah, I think a lot of people got in seeing, oh, this is going to be good. It's money, it's growth, it's generational wealth, which all that is good. But there's also a lot of work and a lot of strategy and a lot of experience needed. And yeah, this now the market cycle is showing who the true operators are.
Absolutely. And that's not a bad thing. And it doesn't matter whether you're syndicating or you're just starting off as a wholesaler or a starting off landlord, house flipper, whatever it is. Everybody has to learn. Everybody has
Mhm.
to grow, but not everybody survives. In fact,
Yeah.
most don't survive long term. Um,
Yep.
so, well, I guess as we kind of wrap this up, what's one question I should have asked you that I didn't?
Question you should have asked that I didn't. We covered all the security stuff.
It can be about anything, Nick.
Oh, I guess I will answer the question that a lot of people ask me. A lot of people ask about finder's fees. They say I'm raising capital. I know somebody that it's a 506c, so I don't have to have a pre-existing relationship. I know somebody that knows a whole bunch of millionaires, and they want to make introductions and they want to get compensated. And I have to tell them the current setup for that is not fun. The current rules for finder's fees is that you cannot have a transaction-based compensation, meaning that your compensation can't be based upon an investment being made or based upon how much investment was being made. In other words, you can't get a commission, and that's what we like to do. If you introduce me to 10 people and I raise $5 million from them, yeah, I'll give you a percentage of that because you've done a great thing for me. That's what we'd want to do. But right now, unless you have a broker dealer license, a securities broker dealer license, you cannot take a commission. You can take a flat fee for the introduction, not for the investment being made. And so that puts operators in a not great position because the operator now has to either bet and hope that if I pay this person $5,000 per introduction, that introduction needs to return me 100 grand plus. And if I pay them for 5 introductions, so I pay them 25 grand, and all five of those people say, oh, I'm not interested. Now I'm out 25 grand. And so the finder's fee rules right now are not fun. Back in about 2020 or so, they had a proposed rule that basically would say, there's a couple of documents you'd have to file if you're a finder, and then you could take that commission. There's disclosures and whatnot as well. And so they had a proposed rule. And usually when the SEC is looking to change things, they'll say, hey, here's the problem. Here's what we're looking at. Here's our proposal. Tell us your thoughts. And then they'll take all that in and either make the rule or change it or what have you. They had that proposed rule and it just sat there for many, many years. And when it came out, I was excited. And then as the years came on, I got less excited. But there's a little bit of hope. In July, a committee reconvened and kind of re-brought up the finder's fee thing. So hopefully, maybe we might start getting a little bit of traction to where finders can actually get that commission without being a licensed securities broker.
Yeah, for sure. Another question popped in my head here. With the accreditation, I've heard for the last couple years that they were going to raise those standards of either your annual income or your net worth. Have you had any thoughts on that or heard any rumblings that you think are valid, or is it all just rumors?
I think this was, I think, in the end of 2023 when this came from. I think this stems from people not reading the full thing. So I think it was like December 2023. Might have my dates off, but the SEC came out and they said, hey, here's what we're looking at. And basically, the accredited investor definition, I think it's been the same since like the 90s or 80s.
Yeah.
And so think about $200,000 in the 90s or 80s versus now. If you have, or let's say 300,000, if you have a couple that have professional jobs, they're probably fairly easily hitting that. And whereas in the 90s or in the 80s, $200,000 or $300,000 was quite a bit of money. And so the SEC wrote like a probably an 80-page thing that talked about here's the start of accredited investor, and here's what the data was at the time. And at the time, there was like not a large percentage of accredited investors in the 80s or 90s, whereas now there's a whole lot. And so they were basically analyzing all this. And basically at the end, they said, these are some things that we're looking at and thinking about. Let us know your thoughts. And so they never said we're going to raise or anything. They just said, hey, we're looking at this stuff. And so I'm still in the camp. I don't think that they're going to do it. Um, Partially because that whole thing, they never said they were going to. They just said, we're looking at this. And then around the same time, it might have been slightly after, but there was a bill, a proposed bill. I don't think it made a whole lot of traction, but I think it was the House of Congress. There was like a proposed bill or something where they were saying maybe we should make a test for accredited investor as well, because at the end of the day, at least my opinion, why we have accredited investors, it's kind of as you talked about, somebody who's accredited, you're not getting their last dollar. If the deal goes bad, they can probably weather that storm. And also the thought is as well that they're probably a little bit more financially savvy and understanding what's going on. And so with this proposed bill, the thought was, well, if they can pass a test, then clearly they can show, at least from our opinion, that they're financially savvy and understand what's going on. So let's let them do what they want to do. I didn't see a whole lot of traction with that either, but I say that to say those two things were happening at about the same time. And I really do think people just didn't read to the very end, which I get it. It was long and not super fun, except to a nerd like me. But yeah, they just said, this is what we're looking at. Let us know your thoughts. And I think people read parts of that and said, oh, the SEC is going to raise the amount. Because I have not seen any other stuff coming out from them talking about raising it.
Well, that's good. You kind of put the rumors to rest a little bit at least. Um, so Nick, anybody that wants to reach out to you, more information, or to get your services, what's the best way for them to find you?
Yeah, they can find me on social media. It's at Nick the Lawyer, so NIC the Lawyer. Or you can also go to the Polymath Legal website. That's POLYMATHLEGAL.com. And on there, there's our phone number. You can message us directly, and you can also schedule a 15-minute discovery call with us as well.
Fantastic. Well, as I said earlier in the show, I've interviewed a lot of people that are doing syndications, but it's really nice to dive into how it's supposed to be done properly. And I'm not giving anybody legal advice because I have a PhD, but that's just a public high school diploma. So you got to have people like Nick, you know. So appreciate your time, sir.
Thank you.
To everybody else, another awesome show in the can. Look, and appreciate you following us, and anything you can do to, share the love, spread the message of the generations of wealth. We always appreciate. Until the next show, go out there and live your vision and love your life. See ya.